just for the benefit of those joining, we're ensuring that all cameras and mics are off during the presentation, just because of the number of people we've got on the event. Excellent. I make it 2 o'clock, so let's be on the dot and make a start. And as I say, I've got Jasmine in the control room who will let people in as we go through. So let's make a start, and hopefully you are all on the right event, brought to you by Excelcare, but I'm actually from Eldercare, so we're doing this as an in conjunction event today. Probably content-wise 45 minutes, I think, and then, as I say, we can open it up for the pre-submitted questions and any extras at the end. So the plan for this afternoon, I've picked that slide because I think that quite represents the care funding system, particularly if you are navigating it for the first time. And in terms of agenda, we'll break it down really into these key areas. Who actually pays for a stay in a care home? It might sound a simple question, but I think actually the answer is quite complex. We'll have a look at the system as to whether it's changing. You may have picked up in the press or through friends that there are some changes afoot. So I want to clarify what those changes are and when they are supposed to be happening. We will have a look around the family home and whether a property has to be sold to pay for care. Again, there are some assumptions and maybe some urban myths that I just want to clarify. And then really in concluding, we'll look at whether there are any steps that a family or an individual can take if they are paying care home fees to prevent that money running out. Throughout these slides, you'll see my company's website address, and at the very end I'll make sure that there's a telephone number and an email address available to you as well, and Kendra from Excelcare will come on at the end as well and make sure you've got contact details for them. So just really by way of an introduction to myself before I start running through that agenda, we here at Eldercare are a firm of independent financial advisors, IFAs, but we've been all accredited by the Society of Later Life Advisors, which is really a sort of minimum gold standard kite mark to look for if you're taking advice in this area. But unlike most of our other sort of SOLLA colleagues from different IFA firms, we here at Eldercare specialise exclusively in solutions for funding care. So whilst we have got qualifications to maybe talk about pensions and mortgages, that isn't our area of expertise. The conversation we're having every day is with families who are wanting solutions for care funding. So I suppose the flip to that is not all IFAs specialise in care funding. In fact, very few do. So Eldercare is actually my company, and it was set up in its current format back in 2007 now. And that was as a direct result, really, of us standing where many of you might be standing today, my grandparents going into care and us getting absolutely no advice. Now, that wasn't anybody's fault. It's a classic case, I think, of you don't know what you don't know when you deal with this. And it was only later on in my professional career that I found out lots of things that would have been really good to know at the time. So I set the business up to share information and haven't really sort of got off the soapbox ever since. Now, we are here at Excelcare's kind invitation and organisation today, but we have no commercial links with them or with any other care providers. This is all about just getting the right information to people at a time that they may need it. Obviously, if we're having money conversations with families, then particularly if we go on to talk about sort of financial products that might be of interest to them, it's really important that we're regulated by the Financial Conduct Authority. This is how you kind of avoid any scammers, by checking on the FCA register anybody you're taking financial advice from, and you will indeed find us listed on there. And I'm talking to you today from Hertfordshire. Some of your homes are very close to us, but actually it doesn't matter where you are or where your family members are. We chat to people over the phone, remotely, email, FaceTime, of course, more latterly Zoom. The reason we do that is it just keeps costs down. So if advisors aren't having to travel and take time, you know, from that perspective, we can deliver a much more cost-effective model. In fact, it means that if you were to call us or join these events or email an outline of your situation, we don't charge for giving a response to any of that because, as I say, it's a low-cost model. So it seems to work. I know some people like the face-to-face, but as I say, we can't operate that free initial advice model if we have to factor in the kind of travel time side of things. Anywho, enough of that, back to the agenda. So we looked on that first agenda point about who pays for a stay in a care home, and trying to keep it simple, I could split this down into saying that there's really 3 main funding streams for care in this country. You are either paid for by the local authority, social services, the council. It's actually all the same place, just given 3 different names, confusingly. You might be funded by our much loved National Health Service. Alternatively, you're a self-funder or a private fee payer. That's the sort of terminology that's generally used. There can be some crossover between the 3, but as I say, I want to try and keep it simple. I should actually just remind you at this point, before you sort of grab any pens, pencils, notepads, the event's being recorded, so Excelcare will be able to send you a link at the end of the event, and then you can rewatch anything that confused you, of which there may be much, or you can share with other family members. So looking at the local authority funding stream, first of all, would I say that's the most complicated? It to some extent is. Some people think if a relative is going to be moving into care, that it's all about how much money they have as to whether you get local authority funding or not. And that's not strictly true. Somebody has to have their care needs assessed first. So the very first step of a funding agreement is that a social worker, so you would contact adult social care at your local authority, ask a social worker to carry out a care needs assessment. And it's the care needs assessment that is looking to see whether they agree, the council agrees, that the person is poorly enough to move into care or not. So if my aunt, who's recently widowed, if she feels that she would prefer to be in a care home, that she would be safer there, that she'd have some activities and stimulation, and she'd have help with some sort of householdy type chores, if she wants to go into care, when she's assessed by the local authority, it's unlikely that they would say she meets their eligibility criteria, and they would say, regardless of her financial position, they're not going to be helping out. She needs to be more poorly in order to sort of trigger the next step of the assessment. So it's a care needs assessment first, and everybody's entitled to have a care needs assessment, and indeed even carers are entitled to have their needs assessed, perhaps for some help with respite care. So it's when that's done, if the individual meets the care needs eligibility criteria, that's when the financial assessment, the money conversation takes place, and that's more commonly known as a means test. And it really is important that it's done in this order. We hear time and time again that a call goes into social services and perhaps they ask, you know, does your mum or dad have a property? They shouldn't be asking those questions until the needs have been assessed, and then they work out who's going to be paying for it, and then the house does come into the equation, which we'll look at in a second. So that's the order in which things should happen. And the financial assessment, the means test, is looking, crudely speaking, to see whether somebody has above or below a certain amount of money. And I'm absolutely sure you will know this figure because it hasn't changed in about a decade. So the figure, the magic figure, the trigger figure is £23,250. People talk about free care in Scotland. In Scotland, it's still means tested, and the limit is only about £5,000 more than it is in England. So it's certainly not free. The area where it's most generous is actually Wales, where the capital limit is £50,000. That's a single, they don't have an upper and a lower limit, it's just a flat £50,000, and these figures are per person. So if we have a couple, married couple, we can double these. Okay. Now, one of the changes that was due to be happening to the system, to the means tested system, was that the 23,250 was going to be going all the way up to £100,000. So literally a quadrupling of the entry point for means tested support. Unfortunately, that has been kicked down the road till at least October 2025. And whether or not it actually happens in 2025, I think might depend on the state of finances in 2 years' time of the country. So at the moment, as of certainly next date, this coming April, when it normally would change, it's remaining at 23,250. Now, what counts as capital? If I were to be really flippant, I could just say pretty much everything. And it is indeed pretty much everything that counts as capital when the local authority is doing this means test. But there's 3 exceptions that I want to sort of just pull out for the purposes of today. The first is if it is a couple, it is only the person, one half of the couple going into care, whose assets are assessed in the means test. So if we have a joint account, joint investments, then it's half of those. If the partner staying at home has an ISA or savings in their own name, then that does not need to be disclosed. It is just the individual going into care. You are not assessed as a couple unless there are joint assets, in which case, as I say, 50% is included. Now, there is an argument, therefore, to say that if a couple has a joint account with £100,000 in it, the person at home really should take their 50,000, their 50% out and put it into a solely owned account just to keep it completely separate. Otherwise, that 100,000 has to drop down all the way to sort of 56,500 in order for the person in care's assets to be below 23,250. So taking their own £50,000 out keeps that safe. So there's a really good Age UK fact sheet around that. It's perfectly legitimate to do as long as you don't mess around with the percentages. So just the person going into care who's assessed and half of any joint assets. The other second exception I want to mention is the often the main asset, the family home, the property. If, again, we're looking at a couple scenario, one half of the couple is staying in the family home, it cannot be included in the means test now or retrospectively. So it is not a case that they'll come back, the local authority, and get the money later. That property does not exist while the spouse lives in it. If the spouse at home also goes into care, then from that date, of course, then the property forms part of both of their means tests. If the spouse at home predeceases the partner in care, then from the date of death, the property forms part of the equation. But otherwise, it does not. There's no coming back retrospectively to get the money. It's also exempt or invisible, really, if a relative over 60 lives there, and a couple of other more unusual scenarios. But that relative over 60 does need to genuinely live there and not just have moved in on the day that mum or dad moved out. So a genuine living arrangement. We could talk separately here all about sort of will trusts and family trusts and all this sort of thing. And trusts are complicated, and local authorities will often look into the timing and the motive. If you are a couple and in your wills, you leave your half of the house to the children because you own the house as tenants in common, for example, that's absolutely fine. Absolutely no question. You're allowed to do what you want with your property in your will. If, however, we're talking about trusts and property transfers while you're alive, then, as I say, the local authority will be investigating those. They'll be looking at the reasons for it being done. And there is a catch-all term, deliberate deprivation, that if they think anything has been done to shelter the asset from care costs, they can treat the individual as still owning those assets. So it's quite a complex area. And if you've been advised to take advantage of any of these sorts of schemes and trusts, you might just want to go back and revisit the robustness in terms of protecting against care fees. And I have to say, if somebody does, in inverted commas, successfully deprive themselves of all their assets, so if my parents were to give away all of their assets and qualify for local authority funding, what they do lose is choice, as we can go on to sort of look at. So just I think that needs to be factored in when we are looking to shelter assets. The third exception I just want to mention, less common, but common enough, I think, to affect some of the viewers here, the investment bond that includes life insurance, which is a type of investment you are likely to have taken out if you have sought professional advice. So it's not the sort of bond that you might get from Barclays Bank or Lloyds Bank, a deposit bond. This is like an actively invested fund. It has a life insurance wrapper around it, and there's a very peculiar law that says you can't be forced to encash it because it would be worth less on encashment than upon death. So the value of these bonds isn't included in a means test. So you might not know whether the person perhaps that you're acting as attorney for has got these, but if you have access to paperwork, we can easily see whether they have or they haven't. They can still be cashed in to pay for care, but they don't have to be cashed in. They are a disregarded asset. So they're the three main exceptions. Otherwise, pretty much everything: holiday homes, stocks and shares, money under the bed, ISAs, rental properties, business assets, all of those things likely to be included in a person's means test. So that assesses whether you have above or below the 23,250, and then might trigger the local authority to then tell you what they're going to pay for you. But you have to also be aware that they look at income also. So I think everyone sort of in the back of their mind knows that there's this sort of limit, and above or below is the sort of key, whether you have money above or below, but seem to forget or not know that income is assessed as well. So if the local authority agree to pay for somebody, they've qualified under the sort of care needs assessment, the local authority will look at their income and they do what's called an assessed contribution calculations. They're now going to work out from your income, what do you still have to pay, if you like, towards what the local authority is going to pay. What are you going to give them to sort of subsidise their contribution? And if you are a couple, you are expected to pay your state pension towards what the local authority agrees to fund for you. But if you have a private pension and a spouse, your spouse can retain 50% of that. Now, the spouse at home is still going to have some other expenses, of course, but that's really a conversation to be had with the social worker about any extra income that might or might not be able to be retained. If we're talking about a widow or a single person, then pretty much they're expected to contribute all of their income, bar a personal expenses allowance, just gone up to about £28.90 a week. They can keep that, but everything else has to be given to the local authority. So some people think, oh, the local authority's agreed to pay. They've said they'll pay for this home and it's costing them £600 a week. We could top up with the pension and that means we can afford £800 a week. No, what it means is the local authority pays £600 and you have to give them the £200. So it's only actually costing them £400. It's quite a misunderstood area. So the local authorities, naturally, with the sort of budgets that we know are constrained at the moment, local authorities will limit what they pay, but they are not supposed to say, here's an amount of money, off you go and find somewhere that will take that amount of money. If you are local authority funded from the outset, they have a duty to not only fund the place, but find a place that will accept that funding level. So if there are no care homes in the area that would take £600 a week, the local authority will have to pay more. They have to find a genuine care home place that they cover the fees in full, you contributing your pension towards that, but no one else being required to pay a top-up. There always has to be a genuine care home place on offer that meets needs with no requirement for a top-up. That's the law. Now, there are two occasions where top-ups can be requested from other people, from third parties. The first is if that local authority place is offered, but the individual or the family don't like it for whatever reason. There's a preference of somewhere else. There's a preference perhaps with a bigger room or a better location or better facilities. That local authority funding can be transferred from the offered care home place to the desired care home. But if that desired care home is more expensive, they could ask for a top-up. Okay, so there's got to always be a no top-up option, but you can transfer that funding to somewhere that might want to top up. That's a matter of choice. Alternatively, the other scenario is if you start off as a self-funder, paying your own fee, having made your own choice of care home, and the money runs out, completely depending what care home you've chosen, when it happens, what the care home contract says, and what discussions took place when you moved into that home. It could be that that care home might ask for a third-party top-up if the local authority won't cover their fee. So that is much more case by case, and it's really, I would suggest, an important question to ask when choosing a care home place. Make sure you understand the implication of the money running out and whether there would need to be a top-up paid if the local authority wouldn't cover that payment. So they're really the only two times that the third-party top-up can be requested. Now that, remember, it's being recorded so you can rewatch. That is our social care means tested funding system. It's been around a long time and there are currently no changes, even though there was talk of the limit quadrupling. When I referred in my agenda to changes to the system, what I'm referring to is something called a lifetime cap on care costs, a care cap. And I know in the sort of pre-submitted questions, a few people have asked about this. This was a change, and you can see I say was because I've got a different date to the one you might have thought. This system was going to be introduced as well as and in parallel to the means tested system. It was never designed to replace it. This is an additional system. And the way that this system was due to work, it was meant to be coming in October of this year, October 2023. But in the budget in November last year, they announced it would be delayed until October 25. And I've left deliberately a question mark there because when that happened previously with the care cap that was due to come in 2016, it got postponed and then it got U-turned completely. So until we get to October 25 and see it actually start in practice, I remain personally sceptical. What I can tell you is if it happens, it won't be retrospective. So nothing that is spent on care between now and October 2025 or whenever it starts, nothing will count towards a person's cap. And as I just said then, it's completely separate to the means tested system. So you'll almost be interested in both. And it might be that people end up being funded under the means tested system long before they even reach any care cap. So it's adding confusion in. And the purpose of this next few minutes is to, I suppose, reassure you that even though it's being delayed and may never happen, it wasn't what it seemed anyway. And maybe don't feel that you've missed out on something or are going to miss out on something because it actually was unlikely to benefit too many people. Does that surprise you about a government policy? I don't work for the BBC, so I don't have to be politically neutral. Now, the monetary amount, the lifetime cap, was set or will be set at £86,000. And that's the figure I think people have clung on to. And actually, most people thought what that meant was if care fees, they were spending £1,000 a week, it would take 86 weeks to reach the cap. That's not an unreasonable assumption, but it isn't how it was going to work at all, because it was only ever going to be personal care costs that would count towards the cap at the rate set by the local authority, not what someone may actually be spending on care as a self-funder. So the difference, called the top-up costs, weren't ever going to and won't count towards the person's cap. I'm going to go through an actual worked example so you can see the numbers on this in just a second. But to make it worse, not only the local authority rate being used, daily living costs won't count towards the cap either. So this would be sometimes referred to as hotel or, your accommodation costs. Now, I think a lot of care homes thought originally they'd have to sort of start breaking down their fees and showing how much is for board and lodgings and how much is for care. They don't have to do that. The government simply said, we'll assume that the daily living cost element is £200 a week, wherever you are in the country, and that's not going to count towards the cap either. So let me give you this example, and you can adjust the figures accordingly, but these are taken from national averages. So the national average for a self-funder is £1,300 a week. That's what most self-funders pay. But most local authorities underfund. And this is justified in part because they block book, they buy bulk beds, so they get a discount. That's the theory. But the gap has widened between those two rates to the extent that probably doesn't stack up as an argument anymore. The argument is the local authorities aren't paying enough. So £600 a week is the average local authority contribution. So if my mum is in a care home that we've chosen, she's happy there, it's £1,300 a week. When she applies for her care cap account, which is effectively run on a computer at the local authority, it's only £600 that counts towards her cap, because that's what the local authority say they'll pay for her if she runs out of money. They'll take the £200 hotel cost off that as well, meaning only £400 of her £1,300 is clocking up towards her cap. So even if she shows invoices, look, I'm physically paying £1,300 a week, the computer says no, the computer clocks up £400 only. So that means it takes 215 weeks, i.e. 4 years and a bit, from whenever the care cap starts. So from at the earliest 2025, it's going to take that long. So we're now at November 29 before my mum reaches her lifetime cap. She would have spent during that time, forgetting any fee increases, nearly £280,000. So that is not by any stretch of the imagination an 86,000 cap on care costs. Now, some of that money's come from her income, some has come from her savings, but that is still her money spent. Now, if she's still a self-funder at that point because she's got above the means test limit, does she then get it all paid for? No, she doesn't. Even if she reaches the cap, if she's got assets, she's still got to pay the £200 a week hotel costs, and she's still got to pay the £900 top-up costs. All she gets is the £400 a week that was clocking up on the computer. She gets that as a direct payment, as cash. So yes, she'll be very grateful to have 20-odd thousand a year to put towards her care costs, but she's still having to pay the lion's share. Back to my earlier comment that most people will have run out of money, dropped below the means test threshold before they hit the care cap, and they'll be funded anyway under our existing means tested system. So absolutely not what it said on the tin, and really important, I think, that you understand that in case you're making plans around this cap coming in and thinking, oh, you know, if we wait till then, we won't have to pay as much. It really, really isn't as it seems. So we've done our means tested social care system. We've looked at the care cap system that was coming in parallel, but currently delayed and on pause. Our second funding stream was our much loved National Health Service. Now, I got quite a few questions around this in advance, and it's a really complex topic in itself, so I can't do it in any way justice today. And actually, I'm not a specialist because I don't have a medical background. I don't do these assessments. This very much is in the healthcare space. So in terms of the practicalities of it, in terms of, you know, when would we know how to, when was the right time to apply for an NHS assessment, etc. I personally think the people looking after your relative, the carers, are the best people to ask. They would know what sort of conditions trigger NHS funding. If you've never heard of this funding stream, I think the best way to think about it is, you know, the sort of care that you would get in a hospital bed prior to being told that you're fit for discharge. The sort of complex primary healthcare needs, that's when the NHS pay. They pay for you in hospital. Just because you're in a care home setting, they should still pay for you. But your needs do have to be primary healthcare. They're not the social care needs such as help with washing and dressing and feeding. That all comes under the local authority funding. It's when it's predominantly healthcare needs, that's when the NHS has to step in, and they're looking at complex, unpredictable, unstable needs. It's not condition driven, so there may be some people who have Alzheimer's that do get NHS funding and some people with the same condition that don't, because it's all how they present with their individual needs. What I can say is that if somebody has any level of nursing support, the NHS will pay something. So there's a level called funded nursing care, currently £209 a week, should be going up next month. That is paid directly to the care provider, and that is for anyone who has at least some sort of nursing care need. But as I say, if you tip over from qualifying for the funded nursing care and they regard your needs as more complex, more unstable, predictable, and you sort of score much higher, that's when the NHS may pay for the lot. But no surprise, it's quite difficult to get. And in terms of, our ageing population, what we haven't seen is the number of people qualifying for this going up in proportion. So it is getting harder and harder as time goes by to get this funding, which is not right or fair. Now, we do work with a few organisations, perhaps a couple of independent social workers, ex-nurses, who, if you thought your relative might qualify for this, you could perhaps have a chat with them and they could manage your expectations and perhaps help support any claim or any assessment if you thought your relative did qualify for. More commonly, it might be something that your relative does not qualify for initially, but if their health deteriorates, they might qualify for it at a future date. So it is, as I say, not my area of expertise per se, other than to say this is not means tested. This is around how your care needs present. And if you are quite poorly, you might get this. If you, however, are not poorly enough to qualify for the NHS funding and your assets put you above the local authority limit, that's what puts you into the self-funding private fee paying category. And about the only semi-positive information I have for you is that you can still receive or qualify for a state benefit called attendance allowance. Now, I've put next month's rates in just because we're only 2 or 3 weeks away from it coming into play. The day rate going up to £68.10 and the day and night rate £101.73 a week. So it's not a huge sum of money, but at the higher level, that's over £5,000 a year, tax-free, does not have to be put on a tax return, as I say, not means tested, and that's for anyone in a care home self-funding. It does stop if the local authority will start paying for you. So it's a self-funder's benefit. If you've never heard of it, don't know what to do, how to claim, we can send you a link. I've even got access to a YouTube video that someone kindly produced, 25 minutes of tips of how to fill the form in. It is a long form. Lots of people think, however, that benefit stops when they move into care, and that's just simply not the case. The only other real sort of state support for self-funders, so that again might not be everybody, and this is quite a niche category of people. This is people who've got the property that isn't remaining occupied, so vacant, not occupied by a spouse, etc. As long as the person going into care meets the care eligibility criteria, back to that very original point, they have to be assessed for their care needs first. If you meet the local authority's care needs assessment, you're moving into care, empty property, and your other assets are under the capital limit, the local authority has to ignore the value of the property for the first 12 weeks of a permanent move. So what that means is they have to fund the individual as if they were local authority funded for those 12 weeks. So that means it might only be local authority rate, £600 odd a week that they'll pay. You do have to contribute your pension during that 12-week period, but you don't have to pay back anything that the local authority does end up contributing. You are a self-funder getting local authority support for 12 weeks. So what that means is the care home can charge a top-up during that 12-week period because you are self-funder, even though the local authority is paying for you. Okay, the mere fact that it's a 12-week property disregard means there's a property and therefore you're a self-funder. But lots of people that get to hear about this think that the money has to be paid back, not the first 12 weeks worth of money, no. After that, different kettle of fish. So I put third bullet point of the agenda, the family home, does it have to be sold? Well, the 12-week disregard period was actually supposed to give people time to think, to give the family and the attorneys time to think about that. Is it a good time to sell? Could we look at alternatives? What about renting it out? Now, renting the property out is worth a conversation in itself. There's lots of things holistically to think about. And some people might be a little ahead of the game here and thinking, well, even if we did rent it out, the rent plus the pension, plus the attendance allowance, still isn't enough to pay the fees. So of course we'll have to sell it. You can't usually easily borrow money against the property, banks, etc. Not that happy. Equity release mortgages, a few people think, oh, equity release, I've heard about that, why don't we investigate it? Equity release mortgages, you have to have owner occupation. And in this scenario, we're talking about the owner having moved out into a care home. So you cannot get an equity release product on a house that isn't lived in by the owner. So where does that leave us? Well, there is an option whereby the local authority can lend money in this scenario. They can lend money for the short term. So after the 12 weeks is finished, they could lend money from week 13 onwards, just for a little while, if you were just worried about cash flow, or for the longer term because you want to rent the property out. So it's called a deferred payment agreement, but as I say, you could call it a government equity release product to some extent. And as I say, you want to think about becoming a landlord if you're an attorney, it separately, just from a holistic perspective, because you might have void periods, you are on call to fix things, got to find tenants and hope that they're, good tenants. The income that comes in rent, and I've been asked this in a couple of the pre-questions, so I hope I'm answering them as I go along. There's no tax breaks for that. In fact, the rental income has to be declared on the person's tax return, and tax does have to be paid. So not only is there no tax relief around renting the property out to pay for care, income tax has to be paid just as it would for anyone not in a care home renting their property out. The property itself could become liable for capital gains tax because it becomes a second property once the individual's lived in a care home for 3 years. Only the gross in value, obviously, from that point onwards, but you've still got to have these things thought through. Still might work, nevertheless, because the money from a house sale put in the bank, getting 2% interest, 2.5% interest, might be less than you would get as net rent after tax. So it absolutely still is worth thinking about, and the property value may go up over time. So if you wanted to go this route, but was still short for money to pay the fees, that's when you might apply for this loan from the government. So all local authorities have to have a scheme available to their citizens. They can still turn it down on individual houses. They can say no if there's low value in the property, or there's already a mortgage on the property, or it's got some structural issues, but they certainly have to have a scheme in place and give you the reasons for turning you down if they say no. They will charge a setting up fee, but no more than a mortgage product would cost, and they can charge interest, which until recently was 2% thereabouts. It's bound to have gone up, but nothing like as much as a mortgage product. You still need to meet their eligibility criteria first, so you can't just move into care without their agreement and get one of these loans. They've got to agree that you have the care needs to move into care. Other assets need to be below the threshold, but here, unlike the first 12 weeks where they'll only pay their local authority rate, the deferred loan, they can lend you the full fee or whatever it is that you need, because they're going to get the money back. And as I say, it follows on from the 12-week disregard. You must get that freebie first, and then it becomes a loan after the 12 weeks. So again, hopefully that covers some of the pre-submitted questions around rental income there. So worth a discussion, worth knowing about. No right or wrong, it's personal choice whether you go this route or you don't. So then really sort of coming towards the latter part now, the last agenda point, when we're looking at self-funders, and we chat to families all week, every day, the concerns are really two main ones. If choosing a care home or working out what care home can be afforded for a loved one, it's really hard, people tell us, and I know, really hard to work out what you can afford if you don't have a crystal ball and you don't know how long the individual's going to live there. So it's all very well saying the fees are X £1,000 per week, but do we multiply that by 52 or 104 or 208? Without the crystal ball, we don't know. So that is an area of concern for people following on from that, because they then want to know what will happen if the money did end up running out. Now, we can't necessarily answer either of those question directly. It's for the care home perhaps to say what would happen if the money runs out, and certainly no one knows how long a person will be living in care for. But what we can do is share a solution with those people that 85% of them, 85% of self-funding families will never have heard of and may never get to hear of. That's not you because you're watching this, so you'll be out of the 85%. But 85% don't get to hear about it, and that's the reason we do what we do. This is a solution that my family would really have benefited from knowing about. Whether or not we would have actioned it, put it into place, who knows? Whether you might hear about it and whether you action it or not, who knows? But you surely, as family members, powers of attorney, individuals, you have the right to at least hear about it, because it can, if it works, remove those two concerns. Okay, so for people worried about the money running out, this can prevent that scenario happening. It won't work for everybody, but we've been doing this 20 years. We're really experienced in knowing, with a few basic details about somebody's finances and their age, we'll know if it will work or not. If someone only has enough money to pay their self-funding fees for a year or for 2 years, this solution won't work. If they have enough money when factoring in their income as well as their savings to fund privately for at least 3 years, this could be worth a conversation. So what am I talking about? What am I talking about? I am talking about a way of capping costs yourself. And as I say, most people don't get to hear about it. It is a type of insurance to some extent, but insurance has a funny effect on people. Some people hate that word, some people understand that word, some people think it's a good thing. With insurance, normally you have to do it ahead of time, right? You have to insure the car before you have a car accident, obviously. But with this type of insurance, you can't do it in advance. You can't pre-insure for a future eventuality of moving into care. You can only insure those care home fees at the time of starting to have to pay them. It might be that you can even buy it after you've started paying your care home fees and moved into a care home. So that's unusual, but I use the word insurance just because it sort of brings home the concept. The technical accurate term for the product is a care fees annuity. So that's the term that you might Google if you wanted more information. However, even the word annuity, and even amongst sort of professionals in the financial services world, often that word conjures up negativity as well. People say, oh, annuities are expensive or annuities are rubbish. And to some extent, I do agree with those people, but they're probably talking about a pension annuity, a retirement annuity. So that's different. Where the similarities are is that both products are swapping a lump sum payment, giving that to an insurance company in return for an income for life. So that's the similarity. But obviously a pension annuity is for somebody typically in their 60s who the insurance company may view that they could be living for another 30, 35 years. They may want a spouse's pension attached. They may want to inflation link it, etc. So what looks like a huge pension fund that's built up over the years, maybe a £500,000 pension fund, when they convert it to an income, maybe only produces 25,000 a year. So it does look poor value. But with a care fees annuity, these people are not usually in their 60s. Our average client age is 89, and they are not typically in good health. That's why they need some support living in a care setting. So the amount of income that you get from your lump sum is a much, much higher percentage than it would be for a pension annuity. The other difference is with the care fees annuity, they are always individually underwritten to take into account the person's age, what the family has to say about their health and care needs, what the care home has to say about their day-to-day needs, because the care home will be contacted to do a telephone interview. And the GP may also be contacted for a sort of copy of the medical records. So it's very much a bespoke quote. If I have 10 89-year-old ladies all wanting quotes, but for the same amount, but with differing health needs, the annuity cost will be different for all of them. Now, we're again pretty experienced at knowing what sort of figures we're talking about, so we would be able to give you a ballpark, but it is always only a ballpark. getting those individually underwritten quotes is really important in making a decision. We act as a broker, so a bit of a sort of meerkat in the Go Compare world. We work out with you what's needed, then we go off to the market, to the insurance companies, and get all the available quotes. We then write a report for you, and in that report it answers all the sorts of questions that you might be starting to think through now, such as, could I move this annuity from care home to care home, or can I have it for care at home? Yes, it's completely portable. You would also perhaps be thinking about future fee increases, and again the report covers off some ideas of cost for index linking the annuity or building in a fixed percentage rise every year, all those sorts of things. In fact, this report, because we've been writing it for 20 years, every time a family asks a question about the annuity, we make sure it's preempted and answered in that report. So it's a really back to front advice process. You kind of have to just buy into the idea of it, do the research, and be sort of trusting of us that all of your questions will be answered once we've got those figures and issue you with that report. The report also looks at how you might minimise the loss, because this product is a gamble. This product is a gamble around somebody's longevity, their life expectancy, in exactly the same way that having the money in the bank is a gamble. The money in the bank could run out if somebody lives a long time. That's the risk you're taking. With the annuity, you're risking a loss of capital if somebody doesn't live a long time. You've bought the policy. If they died early, usually that money's not refunded unless you've built in some capital protection options. So we do look at what those options might be and make sure you've got full advice, including the deferred delayed start date version of the annuity, which costs less to buy, therefore you lose less in the event of an untimely early death. So it really is comprehensive, looking at all the ways you could structure this to try and minimise your risk. It's important, I mentioned having money in the bank, or even money invested to some extent. The money in the bank is only protected up to £85,000. Care fees annuities are also protected by the same scheme, the Financial Services Compensation Scheme, and there's no ceiling. It's 100% of the income that you buy is protected. So in the days where, only this week and another bank, albeit in America, has gone bust, here the annuity is fully protected with no ceiling. So it really is a safe place as far as that's concerned. So the reasons people might take out a care fees annuity would be to either ring fence the remaining assets. If I spend X percent of the estate, then we know that Y percent is protected for the family, for the beneficiaries, or they're doing it so that they never have to worry about that conversation with the local authority, switching somebody over to a local authority contract rate and whether or not top-ups will be requested. This is opting out of any future means testing support because they'll take into account the annuity income. So it has to be set up on the basis that you'll never be able to apply for local authority funding if you have one of these. So it has to be set up properly. You still qualify for anything under the care cap money regardless, so it won't affect that. The only time typically you wouldn't need one of these anymore if you bought it might be if you later on qualify for that NHS funding. Then the annuity income is just paid directly to the person's bank account, so you don't lose it, it's still paid, but does suffer a small tax charge. I explained to you our business model, which, because we offer the advice remotely, keeps our costs down. It means that we can do the research for this option for you free of charge. We also have that experience that we're not going to waste anybody's time getting quotes if we know it's not going to be affordable. If it's not going to work, then you're not going to waste your time doing the research. So it's another reason why we can keep that cost down. As I say, you'll struggle to find other financial advisors that specialise in this space, and if you even find one, there's a good chance they would charge for the research. So we don't. You literally can get the quotes, the advice report, make a decision as a family, and if that decision is no thanks, you walk away with not having spent a penny. We will charge a fee built into the quotes that we provide for you. However, if a purchase is made, because that's what makes us a business, not a charity, we will be paid, but only if you go ahead. So you do know that this is really a no cost, no obligation research exercise. These are the insurance companies that offer these types of products, but you cannot go direct to them. It's not so much that the product is complicated, but it could be that someone needs peripheral advice around claiming attendance allowance or the deferred loan or those sorts of alternatives, and the insurance companies just aren't going to give that advice, we do. We'll approach all 4 of them, we'll haggle with them on your behalf, and we do have a very strong relationship with all 4 because of the volume of business we place with them. In fact, those bottom 2 there, their products only came to market in the last 3 or 4 years, and both companies launched their product through ourselves here at Eldercare. So there's no mileage for you sort of shopping around and going to different brokers, because any broker will go to those 4 insurers and only those 4 insurers. What you need to do is satisfy yourself that you're getting the advice that sits around the product from the best place. And I would suggest looking at client reviews. We have ours posted up on Trustpilot. So if you go onto the Trustpilot website, you'll see, if you look Eldercare Solutions, our sort of last year's worth of client reviews. And I would challenge you to look for similar reviews from anyone else that you were considering getting advice from. These reviews need to be specifically around care funding and care annuities, not about pensions, of course. And just in closing there, I said I'd give you the company free phone helpline, office hours. There's an advice at Eldercare Group email address that you can use if it's out of hours, or you just want to give us a written synopsis or drop us a line with your questions. And that actual page, that specific page of the website, if you are in any way interested in the care fees annuity, there's a page dedicated to that on our website, and it has a Ready Reckoner calculator on there. So you can just input the age of the person you're considering this for, how much income you've worked out that they might need from the annuity, and based on quotes we've obtained for our clients of the same age, it will give you an estimated cost, just so you know in the ballpark. It will change if full underwriting is done, but it's good enough, I think, to give you an indication. So hopefully that will be useful, and there's other helpful information on there, including in the news section, any updates around the care cap as and when we have them. So I've gone 5 minutes over. We're still within the hour for the event, but I've gone 5 minutes over what I said I would. So I'm going to just invite onto the screen to join me Kendra from Excelcare. And between us, we'll wrap up and just see if there were any of the questions on my pre-submitted list that I haven't answered. But I think hopefully I've covered all of those. Within it, we were asked about, the care cap and tax relief on rental income and those sorts of things. So I think hopefully all of that's been covered. Any pressing questions that you had, Kendra, that you think I've missed, or anything? We could probably open up the chat box. Jasmine could open the chat box, and if you have watching got any questions you want to put in there, we can pick those up.
I think, Jazz, if you can let us know if there are any questions that have come through which haven't been answered already on the pre-questions, please let us know. But I think that's been very informative, Nicky. You know, you've explained a lot on there. I read the questions in the lead up to this webinar, and they have all been answered. There's a lot of things that I didn't know about as well. We do all get asked these questions on a daily basis within our care homes, so I'm sure it would have given some of our team members some insight, and you know how to direct them as well, certainly to you. As Nicky did say, we have recorded this as well, so this will be sent out to all of you following this presentation, and anyone that's signed up for the recording as well will receive that. And we'll also send out some literature for Eldercare as well on behalf of Nicky and Eldercare, and some details of our contacts as well for who to get in touch with if you do have any further questions. But I think there are some questions. Jazz, I don't know if you want to come on.
I can see those.
Yes, we've had 2 so far. Are you happy to read them, or would you like me to read them?
I can see those, Jazz. That's great. So the link for the attendance allowance, I'm not technical enough that I can go off and find it and bring it back and post it. I'll lose you all if I do that. However, if you Google claim attendance allowance, it will bring up the gov.uk website, and it links in through there. Otherwise, if you want to contact me through the Advice at Eldercare Group email address, then I can respond with a link to that.
Nicky,
that's why.
If you send me the link to that, I can put it in the email. I'll send everyone with the recording.
Brilliant. I shall do that. Mark's popped a question on around the frequency for a care needs assessment. I believe the initial one, if they do an assessment for NHS fund, depending, if it's a local authority assessment, I would say there's no rules around that. If it's the NHS assessment, normally when they do it, they say it can be reviewed after 3 months and then annually. But again, I think if there's a clear and definite deterioration, it's just worth requesting it. Again, there's quite a lot of information. If you Google the NHS continuing healthcare, there's quite a lot of information that comes up on the NHS website, including a link to the pro forma, the actual assessment that they do, so you can kind of see what the checklist is, what sort of things they're scoring people on. So they'll tell you soon enough if they can't do the assessment until a certain date. So that's those two. Any others? Anybody else typing away there? Oh, thank you very much for sharing the attendance allowance link, Alistair. I've got helpers I didn't know I had. That's brilliant. I will make sure that that goes around in the Excelcare email. It's going to come through to you as well. Brilliant. Long form. It is a long form. What I'll do actually, Jazz, is I'll send you the YouTube link, which is the link to filling it in. So it's got some tips from somebody that might be useful, so you can actually fill in the 28 pages with somebody talking you through the 28 pages.
Sounds perfect. I'll include that too.
Brilliant. Anything else from yourself, Kendra? You got your mute on?
No, nothing from myself. All I really want to say is thank you on behalf of Excelcare and everyone that's joined this webinar today, I'm sure. Just to say thank you so much, Nikki. We really appreciate it.
Oh, you're very welcome. And we'll see you again for another event sometime soon.
Fabulous. Thank
All
you.
Right. Take care, everybody. Thank you.